Welcome, welcome. Welcome, Stephen. Great. So thanks for joining us, everyone. I've got with me today Johnny Dunn, Johnny the Money Mogul Dunn, as they call him. And yeah, he'll be talking about mortgage rates, and I'll be running through a presentation on some of the latest market forecast, what to expect for 2025. And yeah, just sort of a general update on what's happening in the market, what we expect to happen before we shut shop for Christmas. The kids are already decorating the house and driving us mad. So yeah, thanks for joining us, guys. And Johnny, welcome. I've also got Paul Jackson. He's the architect for one of the developments flagship development in Liverpool. He's got many years experience, probably 3 decades of experience. He's a lecturer, senior lecturer at John Moores University. And he's going to talk maybe a bit about sustainability in terms of build and energy efficiency and eco build. So thanks very much for joining us, Johnny. Did you want to make maybe just a quick introduction of DNA Finance and what you guys do?
Absolutely, yeah. So appreciate the introduction. So Johnny Dunn, owner, director of DNA Financial Solutions and Mogul. So you're thinking, well, what's the connection to Mogul? So very into the tech world as well as obviously the financial advice world. Mogul is the UK's first live specialist comparison engine for finance and insurance. So that's what we kind of do behind the scenes. But yeah, absolutely. Today I'm here as call it the money mogul. Hopefully giving you some insight on what's going on in the UK lending market. What's the latest reactions to our recent budget? What's happening with lenders, their adjustments? What's the kind of go-to products for certain investments? I'd love to keep it as free flowing as possible. So from anybody that's got any questions, literally just keep firing them into the chat for me so I can sort of start sifting through what is topical for you. Like when you're looking at your investment strategy, what are you looking to get out from the financing part of it? Because there's so many strategies that we could go through, and I want to make it as condensed as possible for each individual person that's on this call. So yeah, that's me.
Great.
I don't know if you want to
Thanks.
go
Yeah.
next.
Cool. Thanks, Johnny. So obviously my name's Dale Anderson, for those who don't know me. I've been in property investment now for around 20 years. Moved to the UK, London, when I was 20, as you can hear the accent there, from South Africa originally. And then I forged a career in buy-to-let property investments along the way. Some things went well, some things didn't go too well. So I've learned a lot. You do need to be diligent when dealing with off-plan and certain types of investment products, which, may seem attractive on the outset. So yeah, a lot of due diligence, a lot of market research. We try to take data-driven approach. This year, I was awarded 40 under 40. I've actually just turned 40 for best consultancy, and we also won small medium enterprise for most trusted property investment company in the UK. So on that note, I'll just bring up the slides and then run through some of the latest data. Can you see the slides there? Cool. So can you see the slides, Johnny? Just double checking.
Yeah, I can see yours. You just need to
Great.
go.
Okay,
Yeah,
cool.
perfect. Yeah.
Great. Excellent. So yeah, we just want to talk about property investments in the UK. Since COVID, interest rates went up, so things did get a little bit more difficult. But you had a lot of people, especially these social media influencers, claiming the market was going to crash and all that. I mean, it's not happened. It was slightly subdued, but things are starting to look more promising. A bit about Fabric Property Group. We've now done, in the last 4 years, over 400 million in transactions. It's over 1,200 properties transacted and delivered. We've got 300 clients in over 40 different countries, so we deal with different markets. In fact, I was in an event in Qatar, in Doha, with Lynn, who's on, a global agent manager. So if we've got any agents on board, definitely get in touch with Lynn. She's the best, so she was very helpful with the event in Doha. We've done over £1 billion in transactions, and yeah, you can go check our reviews on Trustpilot. We also featured in Forbes, Telegraph, and have won some awards. So what do? We do new build and off-plan investments, but not only that, because investors, not everyone's looking for off-plan. We do have secondary investments, high-yielding serviced accommodation. We source, my business partner Steve, the CEO, he can deal with family offices and source bigger bulker deals. Asset management, we've got Mike Bellini, who's a RICS chartered surveyor. So I'd like to think we've built a really good team of experts, most who are based in the UK, and then I spend my time here in the UK, Cape Town, and then the UK when the weather's a bit better. So yeah, asset management as well. That's something we can help with as joint ventures, bespoke asset management. That side Steve and Mark take care of, as well as acquisition and disposal of property when it comes to exit. So why invest in the UK housing market? If you look at the latest Savills forecasts, they've increased their projections to 29% in the Northwest. But most importantly, it's got a stable and predictable market, good for long-term growth, diversification, especially overseas investors are maybe based in Turkey, Istanbul. We've seen some good demand from there recently, and other territories. Would you say, Johnny, what kind of areas are you seeing a lot of clients investing from or looking at mortgages at the moment?
I suppose, well, where are they investing from? I'll absolutely cover that in my slides. But I suppose, well,
Yeah.
what's the lender appetite is probably the defined question right now, and it's got to be focused in the north of England. Being generalised, and certainly in the bigger cities. Birmingham upwards from the UK. If you think of what do I define as appetite, where it's lenders that are comfortable, less valuation challenges, more
Yeah.
credible. It just seems to be your northern main cities really, if all honesty, where the appetite is right now.
Fantastic. Cool. So yeah, safe and secure legal framework. Of course, there's still some due diligence that needs to be done. But the good thing is, I mean, I've heard people buying in places like Spain and Portugal, they don't understand the legal framework. Whereas we, in the UK, the lawyers are down to everyone involved are regulated to a degree. So yeah, there's a massive shortage. The government needs to deliver something like 250,000 homes a year. We're currently way short of that. I think they're building around 100,000 a year. So we'll see what happens. But demand and supply is the fundamental principle of all investments, and that's really what is driving the market. So this is the latest Savills forecast. As you can see, the Northwest, as Johnny mentioned, 29% growth. Northeast, 28%, and London at the bottom, in fact, at 17%. But of course, London is still a great financial central hub of the world. So still popular, but of course more expensive. Yields are a bit lower, whereas places like the Northwest, we're getting better returns. This is the next 5-year forecast, according to Savills, for rental growth. So not only property prices projected to go up, but you also see inflation. In fact, there has already been substantial inflation in the last couple of years. But as you can see, rents are also looking to go up. On my LinkedIn, I do a lot of breaking news. If you go on there, you can see the latest Zoopla housing report, Rightmove, and they're all kind of saying a similar thing. In terms of due diligence, I think this is very important. When buying property investments, we need to make sure that we almost like when you're buying stocks or shares, you need to check the investment grading and determine the level of risk on the projects to make sure planning permission's in place, to make sure that you're working with reliable developers. And something I've learned more recently is the actual after management is key. So making sure that there's a good local management company in place. A couple of the checks we do, so we'll verify the projects have planning, funding, commercial lending. There's no debt issues, especially if it's off plan. Make sure the prices are relatively good value or below market value in some cases. And then we'll do a legal compliance review, get the lawyers to check everything. Market financial analysis. Again, we need to check and make sure, is the project viable? Something I've noted in the industry, there's a lot of agencies kind of taking, say, 10% deposit, promising investors they might, maybe get 90% mortgage at completion, but without actually doing the mortgage due diligence as well. So one needs to be cautious. There's things like down valuations in the market. I'm sure Johnny will go through that in a minute. But on the due diligence side, Johnny, for you guys for mortgages, what's something that you've sort of seen in the market, or what are your thoughts?
I suppose, well, due diligence, every lender has a different appetite, and it's for us, it's just keeping mindful of what that appetite is. So a lender might have an appetite for a particular type of property, a type of client, whatever it is. They've got that risk appetite there in terms of what they would lend on, but actually, when it comes to it, they may have, let's say, filled too much of one side of that, and then they get a little bit risk averse on certain types of deals itself. So it's about, I think, for us being involved in so many deals, you can see the change of appetites within certain lenders that perhaps have filled too much of their boots in a particular sector. So it's just about really ensuring you're spreading your exposure between the lenders effectively, so you're not overexposing one particular lender to one type of property, one type of client. But that's, I suppose that's just in general, but we see more of that now because of the UK market being so tight when it comes to margin, that lenders are fighting fiercely for any form of profit within deals, and are willing to take a little bit of a gamble on certain things, but they tend to find it's an area that they're not that familiar with. Even though they'll say they'll do it, it's just being mindful when it actually comes to it. They can get a bit wobbly towards the end of it. So yeah.
Great. Yeah, definitely important. We'll go through that later, but I think it's an important part of the due diligence if you're going to be selling with a mortgage, to make sure that, if someone's got £50,000 and nothing else, that they understand the process, and they're confident they will get the finance at completion. So that's why we work with DNA Finance, because we find that they do a very good job, especially with the investor-led type projects. So why invest in the UK from abroad? Probably about 50% of our clients are from overseas, Middle East, South Africa, West Africa, and other regions. I think really it's proactive market regulation. There's transparent legal frameworks. A lot of the properties will be fully managed investments. So if you're a doctor, lawyer, architect, or you work in oil and gas, you don't have time. You need someone you can trust to manage the properties for you. There is the potential of relocation to the UK. And, if you're buying through a limited company or investing a certain amount, and of course, then you've got the exit strategy. My portfolio, I've never really struggled to sell my properties. It's only taken a few weeks, maximum couple of months. The third point is diversified and resilient economy. And of course, you've got the currency advantage. I was actually reading an article since Brexit, the Middle East, it's actually become a bit cheaper because of the pound got a bit weaker. But the pound, certainly in my opinion, it's a stronger currency as gold compared to many other currencies. So I do tend to try and keep most of my assets and money in pounds. High rental demand. You've got cities like Liverpool, Manchester, normal rental yields you can get around 5-6%, but sometimes on the Airbnb model, if they are permitted, you can get up to 8% net yield on your investment. And again, attractive mortgage options, similar to like deferred payment plans like they do in the Middle East and things. You can get a mortgage. A lot of people don't know, if you're South African or you're based in the Middle East, you can actually get a mortgage. And that's something Johnny will go into, because there's a misconception that you can't actually, in some cases, get a mortgage if you're a non-resident. So location focus, we think the Northwest is really going to be the place to look next year. Main reasons, as many know, lower property prices to London, rapidly growing population of renters. There's a huge amount of government investment, especially with Labour coming in. I mean, they've always been quite pro the Northwest. They've just signed off Liverpool Water Visions, which has been in the pipeline for a long time. So while, not everyone's a massive fan of Labour or Keir Starmer, they have been quite pro-North and Northern Powerhouse in the past. So they are helping to get things moving in terms of some of the bigger regeneration projects. So we're on to Liverpool. We've got a development, and I've actually got Paul Jackson, who's the developer and architect, called Dockside Residence. It's a flagship project of 48 units. We had some great success with the project to date. It's selling very quickly. We're near on about 50% sold out. So, of course, if you're interested, or you're an agent interested and you have clients, you can get in touch with me or Lynn. In terms of the yields, the reason we like Liverpool, Manchester, again, has some of the projections for current year and next year. Liverpool 8%, Manchester 7.5%, Birmingham, and then London. And yeah, Liverpool has consistently delivered high rental yields and property value growth. It's a funny one, Liverpool, because there were obviously a few years ago, there were some developers and projects that ran into some trouble. But if you're careful and you work with the right partners, Dockside's actually a recently completed project. It's been operating for 3 months already as service departments. So this is the development. It's located right next to the M&S Bank Arena and the Exhibition Centre. It's a very unique location. It's not often we get something in such a prime area or prime location in Liverpool. And Paul's the architect with us. We'll go into some discussion with him on energy efficiency and how important that is. Perhaps, Paul, do you want to maybe just brief introduction and talk about the energy efficiency of Dockside and the build spec? You're just on mute.
Oh, you're right.
Hi, Paul. Hi. How you doing? Good.
I'm the architect developer for Dockside, based down on the River Mersey. The building, the spec's high. We have a number of items in there for the energy efficiency. We've got 48 apartments with photovoltaics on the roof. A high proportion of insulation, mineral wool insulation within the insulated render wall system, which gives a very good BREEAM rating for the building. So the energy efficiency for this building is very good. The photovoltaics directly linked to the landlord's supply, which will obviously reduce the service charges. Obviously, BREEAM for a building like this is very, very rare. There's also do you want me to talk about the EWS1 and the specification we've gone to there?
Just like how important is energy efficiency looking at like 2024 and beyond? Of course, there's EWS1 to consider for fire and health and safety, so that's all signed off. But it's more about the eco credentials and the importance of the energy efficiency under the new government regulations.
Yeah, well, obviously the EPCs on these are very good. We've got excellent EPC ratings. This is not just down to the insulated walls. It's down to the double glazing that we've put in. It's down to, again, going back to the photovoltaics to the roof. This building all south facing, which is obviously good for the warmth of the building. Even in the winter, you're getting southerly sun. The government's trying to push the green credentials for a building even more, particularly with the Labour government coming in and pushing for it more and more. I'm not quite sure personally where it's going to get. They're going to push for it. But obviously the EPC ratings they were trying to bring the EPC ratings down on the previous government, but this has been put back now. I think they were trying to get it to a D for 2026, I think it was. But obviously that's obviously not going to happen now.
Cool. So it's obviously something in terms of the government. They're definitely
I'll talk a bit about fire, because obviously we've got a financial guide in here. Mortgage. Yeah, so for mortgages in relation to this building, we've got an EWS1, which is an A1 rated, which is obviously perfect for somebody if they're looking for a mortgage. Very rare to get an A1 rated. This was bought in after Grenfell, and if people are unsure, EWS1 stands for External Wall Investigation. So it goes from an A1, which is the highest rating, to an A2, A3, B1, B2. So we've achieved an A1 rated in this building. So that means basically nothing's combustible in this building at all. It's a very safe building. We've gone above and beyond the regulations, so we've got a full sprinkler system, the latest fire alarm system, the latest firefighting lift, and the latest evacuation system for the fire brigade.
Cool. Great. Thanks, Paul. I mean, so obviously that's quite important now. And from a mortgage perspective, that helps as well.
Yeah.
Excellent. So you can see the location here, guys. Dockside Residence. We've then got the M&S Arena. They have all the concerts there. Taylor Swift, all that. I'm not a fan of Taylor Swift, but just to let you know, it was packed. And then we've got the exhibition center as well, where they had the Labour conference. So we're seeing around 72 to around 80% occupancy rates and average nightly rates of £120 plus up to sort of 150 a night. So we're currently achieving the last 3 months about 7 to 8% net. And as years go on, that will go up. So is serviced apartments. Of course, we have other options in Manchester, Liverpool, Birmingham, and different areas, but just wanted to highlight one of our projects. This is the financial scenario. So based on a 1 bed plus study, it is technically a 2 bedroom. You're looking at a projected 5-year return of 68%. And a 1 bed plus study is 244. There are some currently incentives on that as well for cash buyers, paid legals, free furniture. If you're interested, feel free to get in touch. Myself and Lynn can send some more information. And of course, if you are an agent looking to get involved with promotion and you've got clients, get in touch, and likewise, we can help. So that's the buying process: reservation deposits, due diligence, contracts. Within 30 days, you exchange a contract. We'll help with the whole process, recommend independent lawyers. You then complete and you'll start to receive immediate income. So I'm going to hand over to you, Johnny, to go through the mortgage market now. So thanks for your time. I'll stop sharing. And then, yeah, if you want to just give us a quick update on mortgages, and yeah, go ahead.
And absolutely, yeah. Mostly appreciate that. So it's one of the first times I've seen the development from a more of a bird's eye view, to be fair. So it's yeah, really interesting to see. So and I've got I've got a big passion for service accommodation in general. That's my strategy. So if you think of me outside of the finance companies and the tech side of things that I operate in, service accommodation is personally huge for me. It's city centre apartments. Yes, I would even come to the degree from the financing point of view, what the financiers are looking for is what is the rent going to be? Like, it's purely about maximizing as much as you possibly can from that property itself. And in the realms of service accommodation, a living room is in essence could be a bedroom. I mean, my apartments in city centres have got a like a hydraulic wall bed, king size bed in a lounge that you just pull down, and out pops another bed for you to house guests in. And I think it's quite useful to know that, because when we're looking to appoint mortgage valuation companies, etc., when you're looking to perhaps remortgage 2 years down the line, after you've had this set up for a period of time, they're looking to obviously lend as much money as possible, and that would generally be determined on how much rent that you have received. It's always the case in off plan, and it's no that the next time you mortgage that property, so the remortgage is always more of an opportunity than the initial purchase, because it's an established scheme, because you've been able to maximize the rent by changing a little bit of the actual perhaps plan if needed, just being better, I suppose, than everyone else around. So I'll kick off here. This is, I suppose, my section. Am I sitting in the middle of the screen here, Dale? You tell me where I'm sitting.
Yeah, I like that's a nice trick there, just sitting on the bottom left, so I can still see you and the presentation.
And what I might try and do, I don't think it'll work, to be fair, on this one screen. No, I can just see a screen in front of me and I can't see me, but I assume when I sort of wave my hand around, it's somewhere between properties and off, maybe. So that's it. There's me. If you want to connect with me personally, that's an Instagram if you're up to that. But from our perspective, we work with everybody from everywhere. Like, it doesn't matter if you're not based in the UK, it's almost irrelevant for us. You could be based in any continent in the entire UK, and we will have lending that we've got away for most types of properties within the UK. So just first and foremost, that's where we kind of sit. I'm going to talk you through really quickly the process of where we sit, the actual finance, the mortgaging side of things, right at the earliest point as possible. And that could simply down to be the reservation point. Like, you're interested in an off plan or any property in general, like, where can we come in to help you here? Well, certainly if you've got assets in the UK already, let us look at perhaps refinancing those for the reservation or exchange funds themselves. Now, what we like to look at, depending on how off-plan a property is, I mean, some are ready, which is great. You don't have to have a buffer allowance, but ultimately, if you're looking to purchase property that is further down the line, a buffer allowance is really useful, because you borrow more than you need for the reservation and the exchange, and that pot basically pays for those payments until that property is income generating that you're acquiring. In the number of options, a number of ways of being able to refinance that, your properties in the UK could be a remortgage. But simply, you may not have a lender on that property, so let's look at lending on that property as a way of a new lender or a second lender. So you can get second lenders behind the first lender. We'll call that a second charge. We can look to borrow money from the same lender, even if you are within the current constraints of a fixed period. And then there is opportunity where you can actually use equity within other properties without releasing that money. So it's a way of a charge against another property that can help you purchase, properties quickly, really. We call it cross-collateralization. It's basically, you could have two charges on separate properties, but ultimately have one financing loan. Look towards how you are looking to acquire the properties. It doesn't have to always be in your sole name, like limited companies, limited liability partnerships, trusts, many vehicles to purchase properties with. I'd say the fundamental starting point should be a limited company because it simplifies things. Not too much complexities in structure is great for lending. Don't overcomplicate multiple things going on. A simple SPV, limited company, designed for just purchasing that property is more than adequate. But bear in mind, majority of lenders will need personal guarantees and for you also to sign independent legal advice. So bear in mind, it can be done all online. You can get independent legal advice for very, very small amounts of money online, but it's just things to just consider. Mortgage rates do vary between those different options. So if you're going to buy through a limited company or a trust or in your own name, there will be a different level of rates. I mean, ultimately, if you buy a property in your own name, it's a little bit cheaper than it is in a limited company. However, you are subject to tax in your sole name, more so because Section 24 in your own name means that you can't offset the mortgage interest against the rent that you receive. So actually, when you think like you're getting the better rate, it's probably costing you a lot more in tax because you can't offset those interests. So it's kind of worth having a bit of a think of that. There is many other ways to finance a deal. Like it's down to your intention and your plan. Like, what is your plan, your strategic wealth creation plan for the next 5 years? Is it buy and sell? Like, are you acquiring off-plan properties perhaps to sell them? Like when they're established, when they're a couple of years old, the majority of them increase significantly in value. And are you just looking to sell that property cash in to go and do another one again? Or are you looking to buy it and hold the property for long term? I mean, both strategies are great. Off-plan allows for both buying and selling and buying and holding, but it might change the type of product we want to talk about into something that's more short-term, especially if you want to buy it 6 months later, sell it because you've benefited from a completed development that's now gone up in value because all the land registry has been updated with all the properties that have been sold. And yeah, perhaps that you've got Ed Sheeran, Taylor Swift playing on at the arena again. And obviously it's a huge demand for people actually just wanting to stay in that area. So it might change the type of finance that we actually start talking to you about purely based on if you want to sell it or hold the property. So if you want to hold the property, very simple figures I'm going to give you here. Even if you do live and have never bought in the UK and you live abroad, you can still obtain 75% loan to value, potentially higher, but I kind of want to keep it within realms of like you can borrow up to 75. If you want to be conservative, 65 is a great place to be. Especially, I don't know where everybody is tuning into from today. It'd be great to kind of know if anybody wants to put in the chat where you're actually dialing in from today. Huge countries for us at the moment for investment into the UK: Turkey, Nigeria, South Africa, Singapore, Hong Kong, all sorts of places around the world. And we are still able to obtain 75% for the majority of circumstances. And that's whether it's a buy-to-let mortgage or a service accommodation mortgage or any other type of tenancy type mortgage. When you're holding a property, there's always going to be two valuations that we're going to conduct. So one is the bricks and mortar. So when we are ready to send our valuers out to site to determine if the property is suitable and mortgageable, which is a condition of every mortgage application, we need a valuation on what the property's worth and what its rental valuation is going to be achieved. Now, the figures that we get should be what has been provided you to begin with. Generally there's lots of consensus between the valuers that have originated the valuations and also the mortgage valuations, but sometimes there's a difference, and kind of explain why in a minute. From a bricks and mortar point of view, it's simply for the security value to the lender, and that's where the 75% limit comes from. That 75% is determined by the bricks and mortar, but the rental valuation is still required because that could limit the amount of money. Benefits of service accommodation is service accommodations generate more money than standard AST, standard tenancies. Therefore, there isn't as much impact on the reducing 75% because the affordability of the property is better because there is more rent coming into it because it's service accommodation. To understand how that lender uses that rental income to determine the loan, it's what we call the income coverage ratio, the ICR. The ICR is basically a figure that the lender uses, which multiplies onto the rent that you receive to ensure that mortgage payments can still be met. For a property that, of course, is service accommodation, we have a bonus of moving into what they will use as the midpoint projection. So instead of using what it would default to as a standard tenancy, whatever that amount is from a monthly perspective, for service accommodation, we can actually use a mid-range projection for a percentage of the year, which is generally higher. But depending on the lender, depends on which valuation they will allow us to use, regardless of how you're going to rent the property out. So even though we may do service accommodation for you and the lender's fine with that, we still might have to do the standard AST valuation. So it's just things to bear in mind on that. Flick through this really quickly.
Quick question, Johnny. Sorry.
Sure, yeah.
On the limited buying in a personal name or limited company name.
Mm-hmm.
So this question comes up often. Should I just buy in a personal name? Maybe they're buying one unit, they're planning to buy another one or two for retirement or income, or should they actually put it in a personal name or limited company?
So, I mean, the tax advice really should be from like your current position. Like everybody's going to have a very different tax position. It may seem like it's going to benefit you if the property is in your sole name, if you've got a low income within the UK. But then again, there's capital gains in your personal name where there isn't in a limited company. So you pay corporation tax in a limited company, you don't pay capital gains. In a personal name, you've got Section 24, which means you can't offset the interest against the rent that you receive. In your limited company, you can. And although if I look at the interest rate between a personal name purchase property and a limited company property, some differences may arise. But actually, when we're kind of looking at perhaps off-plan exclusively, and let's say an investment heavy block, which, Dockside would look to be because of the huge rental achievements that you can get, it might be the same lender anyway at the same rate, whether you buy it in a personal name or limited company. So therefore, it's probably more logical to say, well, to get it in a limited company, and then you can actually change structures around and not have to worry about capital gains, not have to worry about the interest. So hopefully that kind of answers the
Yeah, I
question.
agree. I think we'll put clients in touch with the tax specialists before they go ahead, and then they'll be able to decide what's going to be best. Because of course you've got corporation tax raised from 18 to 24%, but then capital gains tax, I don't think there's been any change there. So it really depends on your personal income tax position.
It absolutely does. I mean, you don't actually have to be qualified, which is bizarre, to give tax advice. I certainly steer away from it because it's a very personal situation. However, we need to work with the tax advisor because they will have one opinion based on your tax position. We may have one opinion based on your finance position, and it could be counterintuitive between the two. So we've got to talk to make sure what is the right thing to do together financially, because there could be one better than the other. So it's just the whole communication piece. So
cool.
Buying and selling, look, I mean, I've done a lot of this in the past. I mean, I think this comes from my background in building. You can, of course, you purchase through a mortgage if you want to sell quickly, but it is unfavorable to lenders and it doesn't really work because of the early repayment charges. So if you're looking to just buy a property and benefit from the uplift within a short period of time, mortgage lenders not favorable to that, but short-term lenders will be. Of course, you can buy it in cash and then sell it, or even buy it in cash and then refinance it in 6 months, perhaps at a uplifted valuation. If you buy in cash today, there's nothing to stop you, even tomorrow, refinancing the property. It's always a benefit, though, waiting for the land registry to be updated because there's more lenders, and actually it's easier for valuers to do cheaper valuation tools like desktop valuations rather than physically going to properties. So you might find actually you hold a property for 6 months and then refinance. It's a better deal all round, to be fair. That's the short-term finance side of things I was looking to talk through. So you're looking to sell the property quickly, look at a short-term financing route, not a term finance route, which is mortgages, because short-term doesn't really have exit penalties. It's designed to be quick, impactful, and to basically have a chunk of money in your bank. In theory, you do need a little bit more deposit. So instead of 25 being maybe a norm, you'd be probably looking at 30 to 35%. But it can be up to 18 months, which is great. And there's no mortgage payments. And this is the big crucial thing that people misunderstanding, that mortgages, you have mortgage payments. Short-term finance, you don't have payments. So if you're looking to buy the property and you're going to perhaps, rent it out or just want to benefit from the uplifted valuation in 6 months, 12 months, you can just get this on short-term financing to begin with, not have any payments until it's fully tenanted, and then you refinance at 6 months, uplifted valuation. You've got an established property that's doing really well, and I suppose should not really talk about this too much, but in theory, you can benefit from this if you have other properties within the UK. So you can get all the money you need to buy the thing in the first place, but generally you need to cross-charge against other properties you're using in the UK. There's an undecided category, and we call it the hybrid product. So basically it's a year of short-term financing without any payments, and then a year of mortgages after that. So it all depends on the type of product that you've got. So first year, no payments. Second year, start to make payments. And again, you can have a charge against another property for that deposit, which gives you the full amount you need to purchase. Challenges, and I think this is really fair to go through the challenging element, because as a broker heavily in this space, I mean, the biggest brokerage in the UK for off-plan investments, we have all the data you could possibly imagine. Mortgaging and mortgage rates are going to vary vastly. Now, you could say, right, well, the base rate is 4.75 and mortgage rates right now are anywhere between 2.69 and 9%. Where does it sit for a deal like this? Well, obviously somewhere in between. You're not going to look at the 2.69% rate because it's a 10% product fee. It doesn't work very well. So it sounds a great rate, absolutely phenomenal, but that's a 10% arrangement fee. You go slightly to the other end, and this is good case scenario stuff. Like great case scenario, that a higher rate at 5.5% doesn't sound bad, has no product fee. So you've got to understand, do you add a product fee? Do you not add a product fee? Some lenders will allow you, even at 75%, to add a product fee. Some obviously do not. But it's about finding that middle ground piece to say, actually, what works best. Does it work at 4.5%, 5% with a bit of a fee, rather than 5.5% plus without fees? These are the things that we need to kind of go through. But off plan can be niche, but then like so can everything else. Like it's just a type of investment that is niche to certain lenders, like a commercial lender, a lender that will do conversions and renovations, and a lender that just wants to deal with people in adverse credit or have income sources that are in interesting places, let's say. But lenders want to lend, they just have areas to lend in. So like when I was saying at the beginning, when you were questioning me, Dale, you're about, well, what's the appetite right now? Like a lender may look like they have an appetite. And this is what most brokers do not appreciate, because they may have done a deal 6 months ago with this lender. This lender has now not got the appetite to do that, but it's showing on their website, etc., that they do. Unless you're doing the hundreds of deals that we are doing, you don't know what the current appetite is. Therefore, this is where the delays and problems start to occur, because you're not using lenders enough, certainly in this space. Now, standard mortgage brokers, bit of a pet peeve for me. If they're not involved in off plan, this is where we'll get valuation issues, because they will send somebody out that isn't adequate to a lender that really doesn't really want to do off plan. They're not comfortable with a scheme that's going through a regeneration. It's just not their appetite. There's no problem with that whatsoever.
What I've found, Johnny, is some clients, they kind of maybe bought a property as a first-time purchase.
Mm-hmm.
And then they want to buy a buy-to-let investment. They go to their bank. They realize that the bank doesn't deal with the investor-type led projects, so they end up with problems with that. I mean, down valuations have happened recently in the last year, if we're going to be completely honest, because interest rates started going up. Surveyors and valuers panicked that the prices in the market were going to drop, so they started to down value things slightly. So that's the reality of it, but you do need to carefully choose your lending panel. Another thing I wanted to check in terms of, you mentioned short-term finance. I mean, short-term finance, new build off plan typically for me is like a 5-year strategy, right? You buy, you wait, you get some capital growth. So short-term finance, is that more for like bridging, or if you're doing like a buy to flip?
It varies really. So like for what we see in off plan with clients that are looking to, they may look to sell in short term. They may look to sell in a couple of years. There is merit in that for certain schemes that have actually just gone beyond expectations. And sometimes you find that out once you acquire the property. Sometimes you find out just before you acquire the property that actually things have gone a lot better than expected here. And I want to just cash in now and go again. And that might be the right thing to do instead of getting the mortgage. Short-term finance, like bridging. I'm not saying we're using a bridging product, because a hybrid product is a combination of two, and a hybrid product is not a bad scenario if you're looking to create more of a service accommodation experience. And this is where my background comes in service accommodation, that I will take an off plan, and I have done many times in the past, and I will change it a bit beyond what the standard is, because I want more money than the standard. In most scenarios, I've doubled my money more than the standard service accommodation apartment in the same block. So when there's 100 in a block and I've got 1 or 2, mine are outperforming 2 to 1 versus my next competitors, purely because I've just changed things in a way. So my 1 bed is a 2 bed because I've got a king size wall bed in the lounge, with, instead of having a TV, I've got like a cinema style projector with surround sound. So it's more of an experience, nice coffee machines. It takes time to do that, and time where I'm not earning money from service accommodation. But I know if I delay that for 2, 3, 4 months until I've got the whole property how I want it, in the long term, it's great for me. So a hybrid product for me was great, because it allowed me a whole year to not have to worry about a mortgage payment, to then benefit after a year of well, I suppose higher income then kicking in, so I'm ready then for the second year of actually when the mortgage part of the product takes over. And it's not for the faint heart. It's got to be very strategically driven.
Gotcha.
But this is me in my bag, and I rinse and repeat this 20 odd times now to find the perfect blueprint, and certainly for off plan, because most of the off plan is right. It's designed to be completely turnkey, armchair investments. You don't leave. This is just literally the safe investment. And that's great because the figures stack and the lenders like that. what I'm saying is actually, if anybody is a bit more like me and wants to just
Yeah.
push the boundaries a bit more, you can. It's not to say
Okay.
that ceiling height is there. It is with an AST. It is with a standard buy-to-let with service accommodation. The ceiling is what you want to make that ceiling. Like, what
Gotcha.
do you want? And that's what's just really worthwhile
Cool, yeah, and I just
understanding,
wanted
I
to
suppose.
clarify that because we don't like to speculate. I mean, back in the day, I remember people bought off plan, they could sell with a big uplift
Mm.
at completion. But the reality, because of inflation on build costs, I guess new build and off plan, it's not a case like it used to be. You buy it to get a big discount, you sell at completion. But I can see where you add value. You could do short-term finance and then uh, flip it and do it again. So thanks for clarifying. There's a few more questions coming in, but we'll wait till the end and then I'll
Sure.
answer
I've
those
only,
questions.
absolutely a couple more bullet points to go through, and it'd be great to get a bit of a Q&A
Cool.
in. But the new schemes, and this is the challenges. Look, and we're only being fair that if we've got all the data because of the amount of schemes that we lend on, or the literally hundreds of millions of pounds that we're lending to off plan right now, I'm being very, very fair. The high street lenders can be risk averse in these schemes, and it's not because there's any issue. They will come into it in 6 to 12 months down the line when the land registry is updated. But high street lenders typically are very restrictive on where they get their valuation software from, where they get their valuation data from. If you don't use the high street and use slightly more specialist lenders, they may be able to use data from further afield. But generally, regeneration zones, new schemes in places that are designed for a particular type of investor, there isn't many comparables to be used. They could have been pension schemes that have bought them. They've never been sold. So a whole block could, 500 units perhaps could have been bought by a whole pension scheme, never even went onto the market. It was bought and kept. So sometimes there's no data to use. That's not an issue in terms of getting the lending. It just means it's not right for the high street right now, today. And if you abuse the high street, that's where the issues start. And I've got it in line in the bullet point above. This is where the valuations generally occur. The issues occur is when even though a high street lender may look like they want to lend on this particular scheme because everything stacks up and it's all subject to the valuation coming back, they really actually don't want to be one of the first ones in. They'll come in when you remortgage. So it could be a bit more expensive in the first couple of years. Fine. That's generally the case. The remortgage, that becomes the opportunity. And hopefully, if things have gone right, your opportunity to release equity. And we had a chat just before, didn't we, about the exposure limits. And exposures is a thing for really us and the selling agent, Fabric, to monitor, to ensure that certain lenders don't get beyond their limits. And it's very important to keep lenders within their limits because, again, we've got to be very fair for all the buyers within the property that require mortgages to not allow it to go in one particular direction. Lenders may have an exposure limit per floor. It could be the whole per block, but they have it because you're lending within a concentrated area. They do have exposure limits with houses, but it's more postcode specific. But in a block of flats, because it's so central, it's just them monitoring their limits ultimately. And this is my final piece. This is not meaning to sell, but to explain the different types of mortgage brokers out there. Your mortgage broker needs to be registered in the UK. And I make that fundamentally clear that you get a lot of expat and foreign national mortgage brokers that operate overseas. The UK lenders, the majority of UK lenders, do not want to deal with overseas mortgage companies. They just don't. They don't want to deal with them. The compliance is too messy. A lot of lenders just say, "I'm not going to lend to you if you're registered overseas." So first and foremost, that's the setup there. But the mortgage broker and the packager point, which I've got here, is vital to understand when it comes to the valuation. So a packager can actually select the valuation company. And that's really important when you know which valuers are actually representing this scheme well and are using the correct data. Because if you're using a valuation company that doesn't actually know this area, know this regeneration zone, representing a lender that wants to operate within a 300-meter radius, there's probably no great data actually for them to use. So we've got to find the right ones that understand how to value this particular scheme. And it's the full access across the entire market of finance. And this is not just the mortgage territory. That's why I've covered products that don't sit in the mortgage world, because it's really important to understand you want all the options, not just one, because your whole of market mortgage broker has position something in a particular way. We are beyond this territory, beyond the normal areas of mortgage brokering. And yes, rates come into it. Yeah, if you do volumes of business, if you are a packager, you'll get better rates than other mortgage brokers because you're giving them volume and you're giving them quality. If you provide as much business to a lender as we do, you're saving them time. You know them better than anyone else. So they can lend their money quicker. If they can lend their money quicker, they will give you it slightly cheaper. So it's a huge win. Talk to death about the proven record and off plan. This is literally our sector. Don't believe that anybody else does more than we do and has the data to use like we actually do. Yes, we're the one of choice. We can pull people out of some incredible situations to just get things sorted and through. And we like to think that, well, as investors ourselves, business owners and entrepreneurs, we can literally put ourselves in your shoes in terms of like, what would we do in your situation? And there is a growing acceptance here. And this is key to know that off plan is becoming a place for lenders to get to. But we're slowly bringing the lenders on to really understand off plan, but more so investment off plan. Because there's off plan, there's an investment off plan. Off plan where you're in an area where everyone else around you is buying it for their own house and their own home, probably is not as great an opportunity for an investor because the rental yields aren't as good perhaps and the property price is a bit too high. You know, these schemes that we are specialist in are investment schemes. So track record's pretty good. Foreign national expat champion. I'd literally like to tag that in that we absolutely are because of the amount of lending we do overseas. It's crucial to be able to do that type of financing because actually there's a huge portion of UK off-plan properties which is for foreign nationals. The foreign nationals that just buy in cash. Well, if you've bought in cash, that's great. Let's refinance it to go and buy another one. Think of that. If you've got any properties in the UK that are owned in cash, let's have a look at using that equity to purchase multiple properties in a time where we're still going through a bit of a property price boom. Any location, anywhere. Yes, it can be niche. There is a fierce world, fierce world in lending. Off plan is good for lenders because they can help them get margin out. And for foreign nationals and expats more so because there is a slight premium in rates. Therefore, they're getting better margin. You know, they like central areas, like northern cities, mid-northern cities. That's really where things are now. So anywhere north of Birmingham, Manchester, across the Leeds, Liverpool's in that whole section, of course, maybe up towards Newcastle to a degree, but northern is great. Northern works. Northern rentals test really well. And there you go at the end of it. Like, I mean, I think I even written this before the Labour government got in, but the push on housing is positively influencing lender policies to want to lend. We've just got to give those lenders a bit of an extra push really. So sure, we'll get loads of questions. Love you to keep asking me. There's some details on for me there. Second email address down. Of course, you've got your phone out. You can scan my little Instagram tag so you can connect there and drop me a direct message if you want on there about any sort of scheme that you are
Great.
absolutely working on. But yeah,
Thanks, Johnny.
I'll come
Very
back
useful.
in and stop sharing.
So in terms of rates, so they've reduced rates recently. What do you think will happen in 2025? Do you think they're going to reduce them further?
Ooh, so 2025 is going to be an interesting year. There will be aggressive base rate reductions, or they've made note about aggressive base rate reductions. Now, the key factor is inflation, really. And the banks know that, the policy committees know that inflation is a key factor. We've still got quite high wage and service inflation here in the UK. If that starts to come down, they'll probably be aggressive again. I would like to think, and me and Hugh, my business partner, we talk about boring finance and lending all the time. I think by the end of the year, we should be at the low fours, high threes. If we can get by the end of not next year, but the year after, and this is where we've got to look at the end of a really sort of a couple of years from now, something with a 3 in front of it, I think that works for everybody. It works for the rental sector even better. It works for investors incredibly well, foreign nationals. The interest rates come into a playing field where I believe that's a sustainable market. There is an issue with short-term fixes. So if you think a lender is pricing for 2 years or 1 year or 3 years, it's very hard to get the swap markets to give good consistency for short period products. So that's why at the moment a 5-year fix can be seen as cheaper than a 2-year fix or a 3-year fix, because you have certainty in long term rates. So it's eyes on rates, obviously, of course, at the moment. I've seen an expat rate at 5.24%. It's a 1-year fixed. 1-year fixes are pretty good, because you get 1 years of owning a property, then refinance at probably a pretty good time when property prices have gone up, interest rates have come down a bit, and you've hopefully benefited from the price of the property itself. So
I think it's all linked to inflation. The Bank of England cut rates to 4.75% in November. I do expect there may be further reductions in 2025. So that's positive. Inflation's at 2.3% as of October. It was at 10% a year ago, so that's good. And then, just to summarize, capital growth rates are positive across all regions again. Areas in North England, Wales, Scotland seem to be having the most growth, Northwest in particular. I see Zoopla predicts UK house prices will go about 3-4% next year. Rightmove saying the same. So it's all starting to look a lot more positive than it was a couple of years ago, which should also help the lenders and the valuers start to be more sensible. But very important, if you're going to buy with a mortgage, make sure you get your mortgage pre-approved, and make sure you're buying in a project that the lenders and the valuers are happy with it. And because a lot of clients get caught up, they put deposits, down valuations. So it's just something people need to be aware of. So we'll jump into the questions. A couple of questions here. Are you going to cover leasehold versus freehold and pros and cons? So it's not really, we will do this on another webinar, but leasehold title deed is the most common with apartments. The great thing is ground rents are now kind of abolished. So you don't own the land, but you own the apartment normally on a 125, 250 or 999-year lease. The benefit of apartments, leasehold, they yield higher, they're a bit cheaper, but of course freehold is normally your house, which is built on land, and you own the house as well. For investors buying off plan, most of the time it's leasehold. So we can definitely send you some more information on the pros and cons. Can you assist South Africans with getting a mortgage? Yes, we can. As mentioned, just get in touch with myself or Johnny, and we can do a consultation and let you know. So thanks for that question. It's Debbie Shapiro, who I was also speaking to earlier today.
So just on the leasehold, there seems to be a bit of a reform happening on leasehold at the moment, really with the Labour government shaping up with what's gone on. I don't know if you've heard too much over there, Dale, but I think the system will change. I think it might go similar to what the Scottish market have. Let's see what becomes of that. I think leasehold may turn into something closer towards where feudal sits within Scotland. So just more so, let's just keep that as an interesting thought, that it's only, I believe, going to be a benefit, and it will clear up a lot of issues with leases in general. I think it'll be a blanket approach as well. Labour seem to be doing lots of blanket approaches, so it should be a positive for many people.
Yeah, the main thing, you buy a leasehold that's not too low, right? It's like 80 years or whatever. But they're changing the law now so you can renew it for cheaper. Ground rents as well. You need to check the ground rents. Some old properties have high ground rents, and that's why they started to change that. It should normally be like a peppercorn or zero ground rent. So yeah, another question, can we get the audio? We'll send out a recording, no problem. Artie says, what if we made a mistake of buying on a personal name instead of a limited company? Can we change it? So again, we've got tax professionals who can advise on this. I think from a personal name to change it into a limited company, my thoughts are, if you're buying another property, I think you can, but if you've already bought it in a personal name, I'm not sure how easy it is to transfer it. Do you know that, Johnny, at all?
Yeah, I do, actually. I know a lot about transitions between personal name to limited company. I mean, the general rule is, in majority of circumstances, it would be your limited company purchasing from your personal name. So it'd be subject to stamp duty, and then obviously your personal name be subject to capital gains. However,
Gotcha.
if you have multiple properties and you can demonstrate that actually you've been running your properties as a business, in essence, being heavily involved in the management of the properties too, you can actually then demonstrate through a slight loophole, let's call it, a transition between personal name and limited company without being subject to the capital gain and also the stamp duty by your limited company. And it's a very careful process. Majority of times it won't work because most people won't be managing their properties. They won't be running their properties like an absolutely established business. It'd be more hands off and going elsewhere. It is possible, but in the majority of circumstances, if you want to move your property from your personal name to your limited company, it will be a sale from you to your company. Therefore, stamp duty is then payable, and as is if there is a capital gains. So it's just being mindful of that.
Yeah, we'll probably do a whole nother webinar on that at some point, and then I can get on the team that we work with who help with setting up a limited company and how you can move things into trust and buy tax efficiently as well. Because as I mentioned, I'm not qualified to give tax advice, but we do have people that can help. Any other questions? Let me check. I had another client here mentioned, Damien Ackley, bought in Manchester. Project is not completed, delayed, thinking of cancelling, please advise. So sometimes in off plan, of course, due diligence is paramount to make sure funding's in place and the builders can deliver on time. But you do sometimes have unforeseen commercial challenges, and that may be to do with contractors going bust or build cost inflation or just generally delays because of planning permission issues or local councils. However, you should have a long stop date in your contract, and if that long stop date goes past the long stop date, you are legally entitled to rescind your contract, and you should be able to get your funds returned, provided the developer hasn't gone completely bust. But again, if you get in touch with my team, we can assist and advise on that. It's just to make sure that you get the right advice. You should have used a solicitor as well, and really they should be able to inform and advise you on your contract terms and what your legal rights are if you decide to cancel. Again, off plan is off plan. Like, that's why some people like to buy completed. So get in touch. We do also have completed options. Do you also do BRRR deals? So that's kind of like buy renting deals, isn't it? I'm not really big on that, to be honest.
BRR stands for buy, refurb, rent, refinance.
Yes.
I mean, this is I think you guys do, because I know I've spoken to you guys about quite a few, to be fair, and I'm sure there's plenty there. I'd say the question really becomes there of what is right for you and your strategy. An off plan perhaps, and we see the data, bear in mind how much business that we see going through the door of renovated properties and brand new properties, and what is actually increasing in value the most. If your intention is to hold your renovated property versus holding your off-plan property, the off-plan property is being cherry-picked, built and designed in a particular place, which is going to be built for growth. Your off-plan is a refurbished second-hand property that was built however many years ago, which is going to trend by that postcode area market data. So we see the data where actually off-plan at the point of completion increases significantly quicker than a refurbished second-hand. However, of course, the developer that's building it gets the increase between what they've renovated or bought the properties from.
I think my business partner, Steve and Mike, they get involved in some of those, but it is more, you get active investment, you get passive investment. If you're a passive investor, you don't have the time, you just want something fully managed, easy, in a growth area that gives a decent return. BRRR is a strategy where you probably need to be more hands-on on what you're doing or work with the right people to find the right deals. So we do have a department within Fabric that can assist with that. So feel free to get in touch to discuss that further. Any other questions? Let's check here. I think that's it for now. So I think we've probably gone on for almost an hour or so. Like I said, things are looking a lot more positive in terms of the forecast for next year, interest rates coming down, Rightmove, Zoopla, Savills all projecting prices will start to gradually go up again, but we are in a bit of a dip right now. So it could be a good time to potentially look at investments. And yeah, do we have other properties available for sale? Yes, of course we do. We don't tend to sort of advertise them online. Depending on your requirements, we have access to many different opportunities to match your criteria, depending on your budget, what your plans are. Like Johnny said, it's about building a wealth, this tailored strategy and plan for you, rather than just saying you should buy this nice, glossy, fancy building. Let's actually understand you. So feel free to say yes on the comments if you want to book in a call, or we can follow up. Just type in yes. One of my team will be in touch. And likewise, if you want to discuss mortgages, then just put in the chat mortgage, and then Johnny will get in touch with you as well. So we'll just give that a few minutes. How long do you think the current dip will last? I think we're in the dip now, and things will start to go up next year because interest rates have come down. So I expect prices will probably go up 2, 3, 4% next year, unless something dramatic happens geopolitically in the world. It should. I think we are kind of in that dip at the moment, to be honest. Mortgage. So there's a few there. Mortgage. That. Save the chat so I don't lose it this time.
I suppose this is it's one dynamic of property finance in general. I suppose there's huge topics to cover. You know, we could do an hour every day for all year and never get through it all. And I suppose that's where your power team comes in. That's why it's so important that actually, you know, you decide if you want to be an investor that's seriously hands-on. I mean, don't get me wrong, like, I was a builder for years. I was hands-on with all the properties that I've really ever done. And that's my downplay. That's my downfall. Hence why my movement into off-plan and new properties, because it physically got me and my time back. You know, even though that I know the money was there from doing my property up myself, my time was not there. And like, sometimes it's time and money. You know, I turned into a very, very active, hands-on investor, completely the opposite now. Literally no callus on my hands anymore, and just simply just teach people like, how to be a bit creative. But there is some very creative stuff out there. There's some very creative finance plans. Everyone's got a different one. Like, every person I've ever met has got a different strategic approach required based on where they want to be in the next 5 or 10 years. Sometimes it's not always about money. It's about the time that they need to get back. So, playing really well.
Just so we don't take up too much of your time, Johnny, thank you very much for your time today. I know a few people have raised hands. What we would ask you to do is get in touch with the Fabric team directly. Get in touch with myself, Dale Anderson, directly anytime. You can find me on LinkedIn. You can find me on social media. And just we'll be happy to have a one-to-one consultation, jump on a Zoom, and then we can really get into the nitty-gritty of what your current situation is and see how we can help you in 2025. So thanks for your time, guys. Merry Christmas. Have a very good, Happy New Year. And we look forward to seeing you soon. All the best.
Merry Christmas. Take care, guys.
Take care. Bye-bye.